I think we're heading into a correction right now. We've already had 2 days of correction, or 3 days, whatever it is. We're down less than 4% from the high. That's not an awful lot. When you see what gold has done this year, just this year, it's up about, 12% this year. So we retreated about 3.75%, not a heap. So we might have a bit more to go on the downside. But, if you look what gold has done in the last 2 months, is there any reason to think, well, we couldn't have the same kind of return in, if not the next 2 months, but in 2 months later on? Well, that would take us to 3,300 in percentage terms. So I think by the end of a year, for us to be at 3,500 is not an aggressive prediction at all.
The gold market is experiencing a slight correction, down less than 4% from recent highs after a strong rally this year. Despite this pullback, gold gained around 12% in 2024. Further upside remains likely. If past trends continue, gold could see another strong surge in the coming months, potentially reaching $3,300. By the end of the year, a price target of $3,400 to $3,500 seems realistic rather than overly aggressive. AdrianDay, a highly respected investor, explains that gold supply is tightening as paper holders demand physical delivery, driving up premiums and triggering a surge in gold transfers from London to North America. Banks are de-risking to avoid shortages and high tariffs. While this trend continues, it is expected to stabilize over time. Adrian highlights that the Fed is likely to hold interest rates steady for another meeting, especially if job data remains weak. Contrary to earlier signs of control, inflation has been steadily rising over the past several months. Acknowledging this persistent trend, the Fed may delay rate cuts longer than expected. The administration has issued nearly 80 executive orders, including one making English the official language of the U.S. With so many policies in motion, the White House's economic team may attempt to overshadow the Fed by publicly presenting their forecasts and projections. Before we share clips from Adrian's interview, don't forget to subscribe and turn on notifications. Subscribe now and enjoy the video.
But we're running out of gold. The paper holders are going to ask for delivery, and there's not going to be any gold. No, I think it's just tariffs. You look, it started right immediately before the election. When it was obvious Trump was going to win and tariffs were a big issue. It started right there. And of course, the more it's gone on, it becomes self-fulfilling because as more gold came from London over to North America, the North American gold started to demand a premium. So the premium got as high as $30 an ounce at one point. So the higher the premium, then that only encourages more people to bring gold over. So you got arbitrageurs coming in. It's been quite phenomenal. It's about 50 tons, I think, so far has come over, which is really significant. But I don't think it's any more than just tariffs and arbitrage. And I suspect that at some point, just as we saw with COVID, we saw the same thing with COVID when banks in the U.S. were afraid that they simply might not be able to get your gold. Well, if you're a bank, this sounds odd to say, but banks actually like to de-risk themselves. And so if you're a bank, you don't necessarily think you're going to have to deliver the gold, but you certainly don't want to be in a position in COVID when you can't get the gold to deliver. And now you don't want to be in a position when you have to pay a 10 or 20% tariff in order to get the gold. So it was really just a de-risking mechanism.
Yeah, and then as so
it will unwind. It feeds on itself, but at some point it'll die down and unwind. I suspect that they're going to hold steady another meeting. A lot will depend on, if jobs come in really bad. But I think the bias at the moment is to hold steady. And that's because the inflation numbers are picking up. Remember, if you look at a graph of inflation for the last 3 years, you saw a big spike up in COVID and you saw it collapse and you say, oh, inflation's under control. But if you just look at the last 6 or 7 months, this last June, the inflation numbers in the U.S. are on a very, very steady uptrend. And the Fed knows that. Jerome Powell himself has said many times that it's taking longer than he expected. So I think their bias will be towards holding rates where they are for the time being. I mean, look, there's so many things on the administration's radar at the moment. but they sort of can't do all of them at the same time. It's pretty amazing how many, it's almost 80 executive orders already. The last one was to make English the official language of the United States. There's so many executive orders flying, there's so much going on. I suspect what we're going to see is the economic team in the White House try to overshadow the Fed, by coming out more publicly with their own prognostications and their own, projections, and just overshadow the Fed.
Adrian suggests that the U.S. aims to address the perceived overvaluation of the dollar, push other countries to contribute more financially, and lower interest rates to manage an impending funding crisis. Proposed measures include tariffs, requiring European nations to pay more for defense, and even extreme ideas like forcing foreign governments to hold U.S. treasuries to exchange them for non-tradable zero-coupon bonds. Despite gold reaching record highs and gold mining companies generating strong cash flows, there has been no net inflow into gold stocks this year. Adrian highlights a surprising lack of investor interest in North America. Gold stocks remain deeply undervalued, with valuations at their lowest in 40 years. Meanwhile, rising gold prices are outpacing cost increases, leading to expanding profit margins, creating a rare and compelling investment opportunity. Now, let's dive into the interview.
All of this literally, but you need to take it very seriously. So what is it? There's some goals. The goals are to reduce what is seen as the persistent overvaluation of the dollar. There's an aim to get other countries to pay more because there's a sense that the world has been mooching up the U.S. Now, I disagree with the premise, but that's the premise. And then the third one is to get interest rates down because a funding crisis is coming in the U.S. Funding crisis is coming whether it's Trump or Biden or Harris or whoever it is. We're getting very, very close. By the end of this year, the U.S. will be facing a funding crisis. And so those are the three sort of goals, and they're all sort of intertwined in some ways. And so there's all these policies. Tariffs is one of them. Trump has talked about instead of the internal revenue service, we should have an external revenue service to collect money from other countries, to pay for us. There's the idea of having European countries paying more for their defense, and you could make an argument. So there's a lot of different things, some political, why is the U.S. still paying for Europe's defense 70 years after the end of World War II? I mean, that's a legitimate question to ask. And so the idea is that Europe should pay more for themselves, and so on. And then there's one of the more extreme proposals, frankly, is that the U.S. will require foreign governments that hold treasuries, will require them to exchange those treasuries for, are you ready for this? Sit down, or you are sitting. It's the same, only the longer it goes on, then the better the opportunity gets. Look, we talked last time I know about inflows and the absolute lack of interest in North America. When I left, this is now Sunday, right? So when I left Wednesday night, so I don't know what happened Thursday, Friday, but when I left Wednesday night, neither the GDX nor the GDXJ had a single day of net inflows this year. That is, just think about it. Gold is at record highs. But gold stocks are making money hand over fist with expanding cash flows and free cash flow. And yet there's not a single day when there's been inflows into the gold stocks. That's just staggering. Yeah, and the gold valuations just remain very, very undervalued. They're very undervalued. The gold stocks are, pretty, as we told first time, they're pretty much at the lowest valuation in 40 years. Cash flow, of course, is expanding and likely to continue to expand because I think this year, it's sort of a little frustrating to me when every analyst call I've been on, every quarterly call I've been on for the last year, half of the call is spent on talking about costs and how costs are going up and all the measures we're taking to control that costs. That's all very important. But why doesn't someone just come out and say, but the gold price is going up faster than the costs, and margins are expanding? This is a very, 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 I'll say unusual, but also very, very compelling opportunity right now. Because normally, of course, when the gold price goes up, then you see the price of copper go up, the price of steel goes up, the commodity currencies go up, the price of energy goes up, and your margins don't really expand at all. We're in a situation where gold is going up much faster than everything else.
The gold market remains strong despite short-term corrections, with long-term trends favoring continued price increases. Meanwhile, tightening gold supply, rising inflation, and an impending funding crisis signal more profound economic challenges. Despite record-high gold prices, gold stocks remain undervalued, presenting a unique investment opportunity. As global financial shifts continue, investors should closely monitor monetary policies, interest rates, and geopolitical moves that could further impact the market. How could government policies on tariffs and treasury bonds affect the future value of the US dollar? Why do you think investor interest in gold stocks remains low despite record-high gold prices? Let us know in the comments section below. Also, ensure you like this video, subscribe to the channel first, watch the video, and turn on post notifications for more videos like this. Until next time.